All right, let's get right to it. The market is completely stuck right now. You've got Washington's gridlock acting as a guaranteed drag on one side, and on the other, the AI energy boom is quietly building a massive long-term bull case. So today, we're going to lay out a framework for trading this divergence.
So here's our game plan. We'll start with the DC headwinds, then dive into the energy squeeze that's coming. From there, we'll map the sector fallout and get into specific scenarios, and finally, some risk-managed trade structures.
First up, the most immediate threat, the government shutdown. Now look, this isn't just political noise you can ignore. It's a real, quantifiable drag on the economy, and the market is now being forced to price that in.
And the threat here is immediate. We're not talking about a future projection. This is a direct, potentially overnight shock to the income of over 40 million consumers. That's a big deal.
We're now on day 31. Every single day this goes on just prolongs the uncertainty. It freezes up capital, and it forces the market to discount an even worse economic outcome.
Let's talk numbers. That's 1.4 million federal workers going without a paycheck. It's a direct hit to consumption, and you're going to see ripple effects in every region that depends on federal jobs.
And this is the total number of SNAP recipients at risk. What does that mean for us? It directly threatens revenues for consumer staples, for discount retailers, basically anyone who depends on that spending.
So, the bottom line is this. The shutdown is a direct drag on GDP. It cranks up risk aversion, it hits critical sectors like airlines hard, and it even delays key economic data. We are literally flying blind straight into a headwind.
Okay, now let's shift gears. Let's move from the short-term political noise to the long-term signal. There is a powerful, multi-year theme emerging, the AI-driven energy demand shock. And this is a structural reality that you absolutely cannot ignore.
The numbers here are simple and they are stark. Data centers are projected to demand somewhere between 85 to 100 gigawatts of new power every single year. But the US is only adding 50 to 65 gigawatts of new supply. This is a structural supply deficit. It's really not complicated.
So what's causing this? Well, it's massive data center demand compounded by the retirement of older, reliable power plants and painfully slow permitting. And all of this creates a huge premium on one thing, 24/7 baseload power. That directly benefits two sectors, natural gas and nuclear. So, what we have here are two powerful opposing forces, right? A short-term political drag versus a long-term structural tailwind. Let's look at how that divergence is likely to play out across specific sectors.
This map lays it out pretty clearly. The shutdown, that creates a bearish bias for airlines and consumer discretionary. No surprise there. But the energy theme, that creates a bullish bias for baseload utilities and nuclear. And the volatility this whole mess creates, well, that can offer some interesting entry points in quality large caps that get sold off in the noise.
Okay, before we get into scenarios, here's the required disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
All right, now that the key themes are defined, let's game out the primary scenarios for the next 1 to 3 months.
My base case is that this divergence just continues. Volatility sticks around, which demands a cautious, hedged, and very sector-specific posture. The bull case, a quick shutdown resolution that triggers a big relief rally. And the bear case, well, that's the shutdown extending through the holidays, causing real economic damage and a broad sell-off. The bull thesis is simple. The demand for power from AI is just non-negotiable. It's going to override all this temporary political chaos. This is a multi-year theme, and it should reward patient capital positioned in baseload power. The bear thesis is equally straightforward. The immediate economic damage from a prolonged shutdown just becomes too severe to ignore. It triggers a major risk-off event that just drags everything down with it, even the long-term winners.
So let's translate all this analysis into some potential structures. And again, this is purely an educational framework for expressing a view with defined risk. This is not a recommendation.
Okay, first let's talk about a potential hedge against the bear case. The thesis is bearish on the Jets airline ETF over, say, 1 to 2 months. A put-debit spread is a defined risk way to play this. Your maximum loss is the premium you paid, and it's a direct bet on shutdown disruptions. A political resolution, of course, invalidates the whole trade.
Second, a structure for that long-term bull thesis on energy.
The view is bullish on the URA nuclear ETF, but over a 1 to 3 year horizon. A LEAP's call spread gives you long-term, defined risk exposure in a capital-efficient way. This is a pure play on the structural repricing of baseload power, and it's designed to give the thesis time to actually play out.
Which really just leaves us with the core question for your own analysis. Where is the greater risk? Is it in getting burned by the short-term political fire, or is it in missing the start of a multi-year structural shift in energy?
And we'll close it out with the final disclaimer. This is not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.